All right, hello everyone. This is the second webinar in Janover's webinar series. Thank you all for attending. Today we'll be tackling topics surrounding high net worth individuals and some of the challenges and opportunities that the coronavirus outbreak has presented. Now, just as a matter of disclosure, we're not providing any advice, nor should anyone out there take anything said today as personal advice. If anyone would like to speak after this event, please feel free to reach out. Our contact information will be available. So these are certainly interesting times. This is an ongoing series. This is something where we want to take the opportunity to reach as many different topics, as many different groups, individuals as we can. So with that being said, I want to allow the panel to introduce themselves. We're very fortunate today to have Jay Freeberg, to have Brant Cavagnaro, and Sam Scanlan. So I will allow them to introduce themselves. So start off with Jay.
Good afternoon. Jay Freeberg, partner at Janover LLC, tax and accounting firm based in New York. We have offices in New York City and Long Island as well, service clients across the country. I also run the investment advisory firm, JRF Asset Advisors, where we provide financial planning and investment for retirement clients and non-retirement as well, and just help clients with their planning along the way, any stage of their life. Thank you.
Thanks, Jay. Brant?
Hi, everyone. My name is Brant Cavagnaro, and I'm a financial advisor at Wealthstream Advisors. Typically work with high net worth individuals, mostly individuals that earn equity compensation and small business owners, create financial plans for clients and work on lowering their tax bill and growing their investments.
Thanks, Brant. And Sam?
Great. Hi, Sam Scanlan from Houlihan Lokey. I'm a senior officer in our consumer food and retail group. Houlihan is a leading independent investment bank focused on M&A, capital raising, liability management / restructuring. Within the consumer group, I actually head up our cannabis effort, but have also worked across branded retail, apparel, and a bunch of other things.
Great. Thanks, Sam. So I want to take this opportunity to allow Brant to really just give us a very high-level overview of what he's seen from his seat since the COVID-19 outbreak.
So you're saying the market's moved over the last couple of weeks, Zach?
Maybe.
Yeah. So over the last 3 or 4 weeks, it's definitely been quite a wild ride. So just year to date, the S&P 500 is down 23%, which is a huge number, and we haven't seen since 2008. International and emerging market stocks are also down about 25%, and global real estate is down about 30% as well. This has been the fastest drop pretty much in history from a stock standpoint, and we've never seen the market go into a bear territory within a couple of days or weeks like we've had. So it's definitely been a scary time. Looking at it from a positive standpoint, valuations haven't been this attractive since 2008. If you look at the PE ratio of the S&P 500 now, or the Dow Jones, it's close to about 12 to 14%, depending on the day, just because we see some days it's up 10%, some days it's down 10%. It's kind of a moving target, whereas the historical average has been closer to 17 or 18 for a PE ratio. So if you're looking to invest in the market, now might be the time, but of course, there's definitely some more downside risk as people are continuing to digest all of the information with coronavirus. I don't think anybody can look you straight in the eye and say, this is going to happen over the next few months. It's just, we don't know if we're going to go back to work in 3 weeks, 3 months, or a year from now. It's just all over the place there. From a bond standpoint, I'm sure everyone has seen yields have essentially gone to zero. And in fact, if you look at 1 and 3 month treasuries, they have negative yields at this point in time. So something we've never seen before on the fixed income side, but that's kind of been a positive in other areas like mortgage rates, which have gone down precipitously over the last few weeks. So if you're looking to purchase, which maybe not be the best time, but if you're looking to refinance, it's worth talking to your mortgage broker just because yields have gone down so much. And not only stocks and bonds have been impacted, but also cash like money market funds have been heavily affected by coronavirus. There were some issues potentially with some money market funds and liquidity due to potentially having redemptions within those funds. But the federal government has essentially said if they have any issues, we're going to backstop that, and we're going to put the full credit of the Federal Reserve and all of their power into it, so we don't run into liquidity issues there. So what does this mean for the long term? So economically speaking, again, I don't think anybody knows what's necessarily going to happen, but I think we all can agree that the federal deficit is going to have a huge hole in it this year, like, again, we haven't seen before. But when we're worrying about a public health issue, I think that the deficit is something that we're not really focused on right now. It's just getting us back to normal. And from a market standpoint, I think that a lot of economists have been saying that this isn't a financial crisis like 2008, where we just didn't know what was going to happen to the banking industry and just the economics of the country as a whole. And it's not as if we're in a war-torn country where we have to rebuild factories and we just have to rebuild the whole country. It's once things go back to normal, obviously there'll be some companies that go out of business because they can't afford to not pay their rent or just their workers for X amount of time. There is the expectation that we will get back to somewhat normal and pretty quickly. And once that curve is flattened from a coronavirus standpoint, you should see markets go up just because of the positivity and people thinking a year down the road, companies should be up and running to where they were before. That's definitely the optimistic view. I'm in agreement that if things get worse and we don't flatten the curve of coronavirus cases, that's all a moot point. But the expectation is we were humming along pretty well from an economic standpoint and from the market standpoint. We expect companies to go back to where they were previously, assuming the public and our leaders do a good job.
Thanks, Brant. That was amazing. So Sam, you have a bit of a different seat than Brant or Jay at this point. Do you mind diving into what you've seen from your side?
Yeah, sure. So, looking at this from a deal perspective, both M&A and capital markets, what we've effectively seen is the M&A markets have come to a screeching halt. The risk of this virus is not something that people are able to underwrite. Processes that were underway have been stalled. Processes that were going to be launched are being delayed. I think there are a few deals that have gotten done where the financing was already lined up and the banks couldn't credibly step away. But for all intents and purposes, the market for corporate control has pretty much, come to a dead halt. This brings in a bunch of issues as it relates to, due diligence, being able to physically see sites, meet management teams, and the like. Creates contractual issues when you think about MAC clauses and other contract-related items that, something like this is typically not covered under. So it has definitely brought a halt to that market. It has created a huge undertow of restructuring and liability management within the market. This is a truly unprecedented, situation. I think the point made earlier that this is not a financial crisis is spot on. What you actually have here is businesses that have not been stressed. You have businesses that have been turned off. And businesses are not designed to be able to withstand zero revenue. And so that is creating pretty significant shockwaves to the market. I think, as you see this develop, there are some silver linings. As good news comes in, as stimulus comes in, I think there is a sentiment that we could get through this. I can share one nugget that, we have seen Chinese buyers actually refocus in a number of situations that we're involved in, which has been surprising to us. And I think it's a good sign when you see sort of the country where this all originated, start to come out the other end and focus on things like M&A, which are completely deprioritized in the U.S. and Europe. From a capital markets perspective, it's obviously been tremendously volatile, both in the public markets and as well as the private markets. The syndicated market is essentially dried up at this point. There's really no financing available there. The direct lending market is still open a little bit, albeit at much more significant pricing. And lenders are looking at existing deals much differently than they are new ones. So what we're seeing right now is new financings for private equity deals have effectively gone away. We've seen the leverage loan market and the high yield market spike by 600 to 700 basis points over this period. And we've seen over 70 large cap companies basically take out whatever existing lines they have to weather the storm. So it has truly been an unprecedented time. I think as Houlihan, we are very much focused on the private capital markets. And the commentary there is our banks are well capitalized. There is more money within private equity, credit funds, and special situation funds than ever before. And we are basically seeing a tsunami of funds take very different approaches to how they want to deploy capital in this market. And I think people are trying to figure out what they want to do and how they want to do it. But it is a very unique time, and people are getting very creative. And so I think, where there's going to be major needs to come in and rescue businesses, I think there are pockets of capital out there that are flexible enough to be able to approach it differently. There are certain industries that have been hardest hit that we've seen, restaurants being one of them, which employ 10% of the U.S. workforce and already had their own troubles. Obviously, when you think about leisure, resorts, amusement parks, cruise lines, hotels, all bring their own challenges. Retail was already struggling, and, obviously this is not helping the situation. Unique areas of healthcare services like dental have struggled, but there are areas that are doing well. Supermarkets, health and wellness brands are doing well, anything related to consumer health. And I think, as you look at it more broadly, this is a temporary shock. The key is going to be how long it takes to, get businesses up and running. But I think we see a lot of activity in the market and a lot of people mobilizing to approach this in a much different way.
So you mentioned how long it will take for recovery. Do you have a date circled in the calendar yet? We'd love to know.
No, because I think that's part of the struggle. And that's one of the things that's going to be difficult is, it's an unknown, and it's going to be an unknown. The longer this goes on, the deeper the hole, the harder it is going to be to get out. I think the most important thing for, the investor community out there is transparency and understanding where things are. Nobody's got a crystal ball to say that we're going to be through this in 4, 6, or 8 weeks. But understanding that there's positive momentum and some consistency in the news that we get, I think is going to give people the comfort they need to put capital to work to help save the industries here that need saving.
No, very, very well said. So Jay, I would throw the same question over to you.
Yeah, so I'm going to take, first of all, to touch upon Sam's little anecdote. I spoke to a client today, and we talked about some of the things they could do to stay and keep the doors open. And we said, go to your landlord and speak to them about delaying the rent. And she goes, actually, I spoke to them yesterday, and their lease is up next month, and they wanted to renew, and they wanted to negotiate a lower price. And the landlord owns 5 other buildings nearby, of which every building contains a food distributor or manufacturer. So he said, hey, if you don't want to stay in the place, I got plenty of people that will take your space. So the food business is doing well, the distributors, etc. Yeah, so I just want to expand upon and take a little different angle from what Sam and Brent talked about. Most of our businesses are the small, medium-sized businesses, people that have built up those businesses and it's taken them years to do so, or people that own real estate. And they both are in little different pieces, situations. The real estate person, a lot of their tenants are holding off, while the banks have allowed up to 90 days for most banks, from what we've seen, to defer payment on their mortgages. It still puts the landlord in a very difficult position. And the small business owner, obviously business is not as usual. They're dealing with things that no one has dealt with before. A lot of the clients we see are trying to keep the doors open if possible and keep their key employees. Now, most of the employees are not going anywhere else. No one else is hiring, but it's important to make sure that they're happy so that when things do get back to normal, that they keep those people. As far as dealing with, these are all new issues that the clients are dealing with. They're talking about surviving, not just growing their business. So it's a matter of understanding how to survive, looking at their cash flow, projecting it out however long this is going to be, and understand what cost they could cut, what cost they could defer, and really take a deep analysis of their numbers. We're seeing a lot of clients, their suppliers, their customers, they're cut off. And they might have to renegotiate and set up new terms and new suppliers when this whole thing cranks back up again to see who really stood by them. And that's, we talked about that as an accounting firm, stand by your clients, speak to them. I actually sent out an email the other day to a bunch of clients, BCC'd them, and by accident in the subject line, I put "call me to discuss." So I ended up getting 40 phone calls from every single client. What do you want to talk about? So I guess that's keeping in touch with the client a little.
Gift and a curse.
Exactly. Where I think we're going to see the big change going forward is technology. As you see, based on this webinar, I think a lot of clients are going to try and implement technology a little bit more into their business to see how people could work from home, what else they could do to maybe cut costs in the office or in their business, and see how technology will help them. Liquidity is the key right now. I think the high net worth people that have that liquidity, once this thing starts turning around, you're going to see obviously a lot of businesses up for sale, looking for investments. So liquidity is the key for the high net worth person to see where they could put that to work and understand what their strategy is, not just do it wildly. So those are some comments to get started.
Great, thanks, Jay. And we'll stay with you for a minute. What of everything you've discussed so far, and maybe some things that you haven't, has been most surprising to you?
I think the most surprising is, honestly, most clients have been pretty calm. They understand this is out of their control. We're trying to lay out a plan for how they could attack this, whether it be understanding their insurance policies, speaking to their workers, speaking to the suppliers, looking at where their true costs are, their fixed costs. So most clients have been pretty calm about having their business effectively shut down for an unknown period of time. That's probably the biggest surprise to me so far.
Great. And Brant, same question to you. What has surprised you the most over the last, call it 2 months?
I echo what Jay said. I think that how calm our individual clients have been over the last 2 months, it's been surprising and kind of a testament to how we go about our investment philosophy and think for the long term. So on our end, we always recommend at least 6 months worth of living expenses in cash for every client at the minimum, just so if there's times like this, obviously no one could have predicted a global pandemic, but you have liquidity to get you through these times. And in fact, if you have enough liquidity and you don't have any loss of income, now is the time to invest. And I think a lot of folks, surprisingly, have been not only calm, but opportunistic during this time. Whereas in 2008, it seemed like because there wasn't a correction like that in several years, there was more of a freak out. Whereas a lot of the folks that are going through this, that are high net worth, have already lived through 2008. And it's almost, for a good portion of them, par for the course at this point in time.
Very, very interesting, actually. And I think you highlight another good point, just the sheer difference, both tangibly and intangibly, between 2008 and what we're seeing now. I guess
2008 was crazy. It was, you had the banking sector as a whole. They didn't know if that was going to be around in a couple of weeks at a certain point in time. Whereas now we know that the government has already done it in the past, where they're going to backstop a lot of corporations and a lot of industries. So I feel like there's a little bit less of a worry now, because now we passed a $2 trillion stimulus bill. In 2008, that would have been unheard of. That's almost double what the bailout was in 2008. So I think people understand that now the government's going to be proactive and the Federal Reserve is going to be proactive to make sure that there's no liquidity crunch and that we don't have these issues like we did previously.
So let me ask this very broad question and interpret it as you would like. Do you think people are learning anything from this particular crisis versus 2008?
It's tough to say. I think more people learned a lot in 2008, and that was a great education for a lot of folks. But this is just a different animal because it's not pockets that are being hurt; it's people's health. So I think a lot of the calls that I've had, it's been more of a "How are you?" from just an emotional standpoint, as opposed to necessarily just talking about dollars. So I think the lesson here is, as advisors, we're definitely more therapists at this point in time, as opposed to just going through numbers. I think making sure
Does
people
that
feel
affect your rates?
comfortable about. What was that?
Does that affect your rates?
No, it doesn't
Bad
affect the
joke,
rates,
sorry.
but it is a great opportunity to connect with people at a different level than previously.
Yeah, I think this is Sam. I think what we've seen is, obviously everybody's very concerned about everybody's health and well-being first and foremost. And I think what we're also starting to see is that everybody is trying to take very creative approaches. I think everybody sees this as a huge problem, but one where that's going to be solved by innovation, creativity, and working together. And I think that's one thing that's a little bit different. I think everybody realizes that nobody caused this. This was caused by, who knows how the virus developed. And as such, you're seeing a lot of people really try to do the right thing in situations, treat workers the right way. And if they're not, be shunned for it. I think it's a very different mentality. We will get through this together and we will find unique ways to do it. We just hope everybody's safe and healthy in the interim.
I completely agree with that. And it's a very, very interesting point in that we don't really talk about the altruistic side, where you see different manufacturers switching over from whatever their natural products or services would be to create services and products that are absolutely needed in the market today. So it's fascinating, something we probably haven't seen since World War II.
Yeah, I also just saw United Health today is giving $50 million to, I guess, companies to help develop the antivirus for this thing, the cure. So it's companies are chipping in to help, which is nice. And
again, it's a unique opportunity for different groups out there to maybe establish markets that they didn't have access to previously. And I just want to follow up Brant's point before with you, Jay. Do you think that the clients you've spoken to will learn anything from this? Will they adapt any of their habits long term?
You hope so. You hope so. A lot of them, I think, are focusing on really which of the employees that are sticking by them, and they want to stick by them as well. And I think they're going to relook at their business model as far as, I have some clients that are sourcing from China. I think, one source location, whether it be where it's started, that has nothing to do with it. I think they're going to relook at, where they're getting all their supply, where their supply chain is coming from, and make sure they're diversified enough that if there is a problem, that they don't get cut off.
Very good point. Sam, I want to send it over to you. So you spoke a little bit before about the impact that there's been on deal flow, that there's been on the capital markets. How big and how long lasting do you think that impact is? And do you mind diving a little bit deeper into just maybe some of the changes that you've seen? And again, similar question to the other guys. Is this a long-term change? Do you see any long-term adaptation from different groups out there?
Yeah, so, hard to say. I don't necessarily in my world think anything is going to fundamentally change from this. I think we'll obviously learn some good lessons. We'll learn some tools that worked and tools that didn't work. But fundamentally, the markets of M&A and then just general capital markets have become so sophisticated that there's a lot of flexibility to handle this, and that's sort of the good news story. In terms of how long this is going to last, I mean, I think the M&A markets are pretty much going to be shut down until we come out the other side, and so however long that is, I think they'll be shut down. I think aspects of the regular way capital markets will be shut down for a period of time, but I think private pockets of capital are going to be incredibly active. We're hearing, big name private equity firms that are reallocating capital to deploy in unique ways in this environment, to come in and save industries where they have, expertise and understanding in a very unprecedented way. I think you're going to see people utilize the bankruptcy code in an interesting way. I've actually had somebody float to me that some have talked about folks going into Chapter 11 just through this, and then the second it's over, coming out, just to protect themselves from payments and to stay afloat and alive. And so it's one of those things where you're going to see a lot of market activity. You're going to see a lot of creativity. And I think we will come out the other end through a bunch of tools and strategies that haven't been used before.
That is a perfect segue, actually. Brant, do you mind maybe walking us through a couple different examples? Maybe not that you would advise anyone outside of a very specific engagement, but what are some examples of strategies that you could foresee being utilized in the near future?
So two strategies that come to mind is tax loss harvesting and rebalancing. So it's funny when you speak to individual clients and you say that you have this opportunity because of your losses, they say, what are you talking about? The losses aren't good, but there is an opportunity to save on taxes down the road. So tax loss harvesting is a tool where if your security, if it is dropped lower than the basis that you paid for it, you can sell that security, purchase another security in the meantime, and you're able to take that loss that you generated and offset it against future gains. So for a lot of our clients that invest in mutual funds, we've been very aggressive about taking tax losses this year while reinvesting in similar holdings, because you don't want to miss out on a day in the stock market, especially like the last 3 days where it's been up substantially. So mutual funds generate what's called capital gain distributions towards the end of the year, where all the trading that's done in the mutual fund, at some point, they have to spit out the capital gains to the individual investors, which is a little bit frustrating depending on the funds that you're in. But by taking these tax losses now, you're essentially potentially offsetting years worth of gains that you'll pay in the future. The one issue that needs to be considered, though, is it's not a free lunch. You are lowering your basis in a holding compared to what it was before. So when the market does recover, now you're going to potentially have this huge gain in another holding. So you need to make sure that you look at a client's tax situation now and in the future to see if it really makes sense to lower basis. And the second, rebalancing. So that's basically if you're in a 60% stock, 40% bond portfolio, and now you're 50% stock, 50% bonds, we've been very aggressive about rebalancing and actually purchasing a lot of these stock funds at a discount, because I always say it's better to purchase the market when it's down 30% than when it's at a high point, because you're getting at a discount, and we haven't seen these discounts in 12 years now. So I think once we see the market go up and folks have more shares in these stocks or stock funds, they're going to see a much greater appreciation of their wealth as opposed to if they just stayed still.
Amazing. And I know this is not one size fits all. So again, thank you for taking us through a little bit of some strategies. Before I pass it off to Jay, just to more or less ask him the same question, I just want to let everyone out there know that the Q&A section is open. So if you have any questions whatsoever, please feel free to populate and we'll address them as quickly as possible. So Jay, what strategies, just examples of strategies, would you have for potential clients out there right now?
Well, I'll back up a little bit. I think Brent did a very good job on the investment side strategies, and I would probably look from the high net worth individual, look at all the other financial planning areas, and while they're sitting at home over the next couple of weeks, take some time and really make sure that they're doing everything the right way. The first one is insurance. Do they have the right life insurance? Retirement. Probably a lot of people are thinking, at least last week, that they might not be able to retire as soon as they thought. So review your retirement accounts and retirement plan. Same thing, estate taxes, estate planning. And I mentioned this the other day, but as you saw in China, after this whole thing ended, the divorce rate skyrocketed. So you might want to think about what planning you should do before you get out of the house. And investment Brent talked about. So the strategies I would focus on are really take a look at your total picture, where you stand, insurance, estate, retirement, taxes, and investment, and plan out what you need to do. Speak to your investment advisor, speak to your accountant, and make sure you're headed in the right direction and are able to withstand and not have these major up and down investment cycles affect you as much as it should.
Great. Sam, same question to you. From your seat, what are some examples of some strategies that you might have for a potential deal in the future, or just from your general seat as an advisor?
Yeah, so I think what you have and what we talk to our clients about, who are mostly private equity firms and family offices, I think what we kind of tell people is to look at this as an opportunity to potentially pounce on some assets that are depressed because of things outside of their control, and to really invest opportunistically in things that they understand and things that they can kind of underwrite to they're affected. So for instance, now's probably a time to double down on good restaurant assets if you believe in the space, because there's going to be a lot that aren't going to make it. And there's already been an oversupply and overly competitive, but I also think you're going to see good assets at a discount. And so understanding that and having a strategy to do that is what we're talking to people about. And in some cases that could be loan to own strategies. In other cases that could be coming in and consolidating things. But there's, we're kind of encouraging people to be opportunistic, because our client base has felt that the market was hot for a long time. People were paying big multiples and big prices for things. And now maybe is a time to do some of the things that you would have liked to on a cheaper basis.
Very good point. And again, another perfect transition. What new efficiencies, Sam, are you seeing right now? And do you think, is this a long-term change? So what do you think your clients have learned at this point?
Yeah, I think everybody has to take a look at who you are in the ecosystem. So if you're a smaller middle market private equity fund, you're not going to be able to, execute on new deals, right? There's just not going to be the debt financing out there to do it. So for them, it's important to look inward and properly manage the companies you have today. To roll up your sleeves and get comfortable working with them, because what we're starting to see is, given all the uncertainty and all of the logistical challenges that we're all facing, it's that much more important to stay connected and plugged in, and that's what those folks are doing. I think if you look at some of the larger asset aggregators, they're sort of looking at this and saying, well, I don't need I don't need third-party debt financing to do deals. This is an opportunity for me to opportunistically over-equitize deals at good prices that I like, and I'll deal with the financing on the back end. And so I think everybody's sort of looking at who they are and figuring out the best way for them to navigate, this environment, and it varies greatly.
Oh, very good point. So, Brant, very similar question. What new efficiencies have you seen to this point? And again, do you think this is a long-term change?
It's tough from an individual investor standpoint. There's really no efficiencies or anything different. It's just markets, as much as they change, they're the same at the end of the day. I don't think there'll be any changes from an investment standpoint. If there's any changes we see, it'll just be the nature of investments within the U.S. market or international as a whole, where some of these new sectors that'll come about because of coronavirus will be a larger part of a portfolio, just because some other sectors will go by the wayside, or you'll just see kind of the cream rise to the top there. So again, it's more change from just the component of the investment as opposed to just efficiencies around investing.
Great. And Jay, same question over to you.
The efficiencies, I take it personally, in the sense that for the past 3 days, we haven't gone out of the house and haven't spent a penny. So, and we're still alive and kicking. So I think you're going to see a lot of individuals refocus on their budget and understand, and hopefully put more into their 401k, have more spendable dollars on things that they really want, experiences, not things, and just make sure that they're leading a better, happier life. So I think it's looking at their budgets and reallocating the money to where it makes a little bit more sense.
Great, and good advice for us all, really. So a question for all of you, actually. Are you bullish or are you bearish as to where we'll be 3 months from now? And I know that's a very loaded question, and interpret it however you like.
That is very tough. Bearish because we're going to see a lot more positive tests. We're going to see, unfortunately, some deaths as a result of coronavirus. So I think bearish over the next 3 months because we don't know what we're going to experience. But after that, I think we should be bullish just because the resiliency of the American people, and if you believe in capitalism and that businesses will continue to make money or try to make money regardless of the circumstances, I think that's a great opportunity, but it's tough when you have this health issue in the forefront.
Jay?
Let me unmute. Yeah, I mean, I think in the very short term, we're going to be flat to down. I expect probably another 10% on the downside. It has run up a lot more than what I thought. I thought markets would freak out a little bit today with the unemployment number and with the bill, thinking that it wasn't good enough. But then once we get back to normal, all things were humming along. So we're going to have some businesses in some areas, sectors, no doubt about it, that will not do well in the short term. But overall, I think we'll get back to where we've been and keep riding, and we'll see what happens election time.
Great. Sam?
Yeah, I think I share similar sentiment that the near-term struggles are going to continue. I think you're going to keep seeing volatility. As I kind of mentioned before, I think part of the issue people have is not being able to underwrite what's going on here. And I don't think that's going to change in, the short term. I think hopefully come the fall, we're starting to move out past this. And then I think, again, you're going to see, an election always creates a lot of uncertainty in the market. So I think, certainly bearish in the short term. And then I think some of it depends on how our political situation evolves.
That is the unseen variable here, politics, which could drive things in any number of directions. So I think we've reached the point where I will open up the floor to Q&A. And while we gather a couple of questions on that side, final thoughts from you guys. Anything that you think the general public should know, understand, maybe we didn't get to at this point? Brant, I'll start off with you.
I think just some advice would be just speak to your professionals and make sure that you have someone to talk to. I think, I forget who said it, but we're all in this together. So we just need to make sure we're continuously speaking. And if you have to ask questions or you just need someone to talk to, make sure you speak to your professionals and make sure you have a game plan and a roadmap for the foreseeable future, because there's a lot more power in kind of having a roadmap as opposed to going in blindly. So I think that's something that I would recommend over the next few months.
Great. Jay?
Yeah, I agree with Brent, and just remember that everything is changing on a daily basis. So if you speak to your professional yesterday, be aware the laws are changing. They're coming up with new laws, new bills. So just keep in constant contact. And I think everyone will be okay. It'll be okay. Just another month, and then we'll be back in our offices. That's what we're looking at.
So it's all sunshine and rainbows from your side? Is that what were the takeaway?
Well, it's obviously the next month will be tight, but I think in the next couple of weeks we're going to hit the peak, especially in New York City. I don't know, haven't been following the rest of the country as much, but I think we should be hitting the peak in the next few weeks, and hopefully the markets will hit the bottom in the next week or two, and then we'll see the upside from there.
I hope you're right.
Yeah, no, I agree with both of those points, that this is a very dynamic environment. And, staying close to what's going on, staying close to advisors, I think is spot on, because there's going to be a lot of opportunities and a lot of changes and nuance that you weren't necessarily aware of. I think that I would piggyback on that to say that it's also a time to stay in touch with networks. I think you're going to see a lot of innovation and creative ideas and ways to navigate this. And I think a lot of good opportunities are going to come out of that. And so, I know myself personally has taken some of this time to call old friends, old colleagues, people I've worked on deals with in the past, and, have conversations with them about what they're seeing, what their ideas are. Because there is a dynamic environment, and there are lots of people that are going to, attack it pretty creatively.
And I think you bring up some fantastic points there, not forgetting the human element, which, we've hit on quite a bit through this time, that while there is, of course, the economic side to this, there's the human side to it. So I think that's a nice way to really wrap up this session. So I want to thank everybody for attending. I especially want to thank Jay, Brant, and Sam. You guys were fantastic. I really hope that the relatively positive net outlooks are true as they can be, and that we can all move forward, across the country, across the world. So again, thank you so much for your time. We will be saving this and broadcasting it for future consumption. So please keep a lookout for it, and we will see you on part 3. Thank you.
Thank you, Zach, for hosting.
Thank you.
All right, thank